and welcome to Ask an Expert. Today I'm joined again with Chloe, the mortgage broker. She is here to talk to me about interest rates. Interest rates are a big deal. They have a big impact on what you can afford, and everyone seems to want to talk about how low of an interest rate they get. Chloe, can you share some insight as to why interest rates are so important when it comes to financing?
Yeah. So obviously, everybody wants to have the lowest rate. And right now, everything is at an all-time low. So, you get a low interest rate, you pay a little bit more principal. You get a low interest rate, your monthly payment is a bit lower. So it's definitely something that everybody's searching for, but it's not always the most important thing. You always want to have good terms in your mortgage. If you know that in the next 5 years, you might make a move, you want to make sure that the penalty is not going to be some crazy number. There's a lot of mortgage lenders that will offer a really low rate, but the penalty is actually going to be calculated at a little bit of a higher rate. So you really need to figure out what your client is trying to do, what their plans are for the future, so that you can best give them these options that they would best suit them, right? It's not always about rate. And also you have to remember too, everybody who researches rates and goes on Rate Hub and all this stuff, you don't always qualify for the lowest rate. Right? Like there's a few factors into what you get, and there's 3 categories that you can get pre-approved for, or a rate that you can qualify for. Insured, somebody putting less than 20% down when they make a purchase. Those are the lowest rates on the market right now. Sounds kind of crazy, but that's what it is. Then you have insurable, and those are people who are putting 20% down or more, but they're qualifying on a 25-year amortization. So they get sort of a middle rate. And then there's the uninsurable, and that is somebody who is purchasing on a 30-year amortization and putting 20% or more down. They get the highest, still low rates, but it's the highest of the 3. That's how people qualify. So yes, rate's important, but it also depends on what you're doing.
It's so funny because so many people will find that it's backwards, especially when it comes to having an insured mortgage, right? Like, so for those who are unaware of what we're talking about, an insured mortgage is something that's insured through CMHC and Genworth, I think, are the 2.
And Canada Guarantee. Yes, there's 3 insurers in Canada.
Oh, 3, Canada Guarantee. So when it's insured, it means that if you default, if you stop paying your mortgage, then that bank will be able to go and pretty much get the money from the insurer if you default, and then the insurer comes after you for the money. Is that how that works?
So the CMHC insurance, this default insurance, it's not there to protect you. It's a charge or a fee or a premium that you as a buyer will incur if you put less than 20% down. What it's there for is to protect the lender. Right. So it's there to, if you default, simply put, it protects them in getting their money back or not losing their money.
Yeah. And so the reason why you're saying that the people with insured mortgages have actually better rates is because the banks are like, you know what? I have somewhere to go if you guys can't get it. And that's also why, would you agree that the mortgage insurance companies are going to be more stringent with the lending practices than the actual banks that are lending the money? Or do you find that they're equal?
With mortgage insurance, like what do you mean?
No, because from the deals that we've done, like I found that a lot of times the main hurdle after you get the bank to say, yeah, this is good, provide us the documents, you have this income and this and that and the other thing, and then it gets to CMHC or it gets to Genworth or First Cap, or I don't know the third one that well, but by the time it gets to them, they're the ones who more often than not kill a deal than the actual lender. Because like the lender can give you a quicker response, but the underwriters at the is it underwriters at the bank and at the mortgage insurer?
So what happens is, if it's an insured mortgage, the first stage of approval is through the lender. So if the lender approves it, then they send it to CMHC, get Genworth or Canada Guarantee, and then they have to go through the second phase of approval. So now they're going to look at it and whatever their criteria is, et cetera, right? If there's value that they have to look into, whatever it is that they do, they have to be the second step of that approval. If they don't approve it, well, we can try a couple different things. We could try sending it to one of the other insurers, or it, gets done or it doesn't, right? Like often It's not often that it gets killed, but there are some. And in those instances, it's more about the property, or if there's some issues with credit, if there's low income for the borrower, but they have a cosigner, and you maybe not all the down payments coming from maybe the cosigner as opposed to having some funds on your own. So it's the overall strength of the actual file that might deter an insurer or a lender from doing the deal.
Yeah. So there's a lot for people to think about, but certainly that's why they have professionals to help them get through this process. You're not expected to know all of this information, but certainly understanding that the interest rate is impacted whether or not you have an insured mortgage or not. And the fact that you get these higher or these better quality low rates because you have lower down payment, but it's not because of the down payment, it's because you have mortgage insurance. Can you get mortgage insurance if you have 20% down? Like, can you pay for it even though?
So there's some programs that want it, right? So for example, if it's a lot of lenders don't do this anymore, but purchasing in a holding company name, there's very few lenders that do it now, probably only a couple. It used to be bigger, but now they've trimmed it down, and they sometimes will want it to be insured. So that is an instance where somebody's putting 20% or more down, depending on what is required, and still being an insured type mortgage, just to give the lender a little bit more confidence or security.
Yeah. What else do we need to know about rates? What are some of the other terms that impact someone's mortgage other than the rates themselves?
So penalty is a huge factor. You can get, a difference of maybe 5 to 10 basis points in a penalty or a product. So you can actually get a rate that is a bit lower, maybe 5 to 10 basis points or more, but it'll have an actual higher penalty if you were to break it. So if it's a first-time buyer, chances are you could probably do that type of a product for them, because you're usually it's a good chance that you're at your home for about 5 years if you're a first-time buyer. If you're second time, third time, fourth time buyer, then you have to figure out what they're doing in the next 5 years, right?
So can you explain what a basis point is for those that are not in the industry?
Sure. So basically, if you have a rate of, let's just say 2%, you could potentially get a rate of 1.9% for maybe a higher calculated penalty. So yes, if somebody's rate driven, you want to provide that option, but you have to disclose to them that, hey, if you break your mortgage, that regular or that 2% product is a regular penalty, or a much lower penalty than the 1.9%, right? So if they're okay with it and they want it and they're like, no problem, we're not going to change our mortgage, then go ahead and do it. But it's explaining to them what the difference is and why there's a difference and what the different terms are in each mortgage. For the most part, you can get like portability and prepayment privileges and all that stuff, right? And there's online portals with all these monoline lenders, which are basically the equivalent to a bank, except they don't have a physical presence, right? So they don't have overhead like a bank, so they can offer much lower rates.
Yeah, for the most part, you're saying that the lower the rate, the chances of having a higher penalty is greater.
Right, if it's that type of a product. Not necessarily in every instance, but sometimes.
Yeah. Now, when it comes to penalties, what I know that there's one or the other. It's like 3 months interest or the rate differential. Can you explain
interest rate differential.
Yeah, can you explain what that is?
So it's the 3 months interest with a variable rate is that simple. It's literally 3 months interest. So it's your interest rate multiplied by your current balance, and then obviously divided by 4, right? So 3 months interest, pretty easy to calculate, and it's pretty standard in a variable rate mortgage. It's also much lower than what a fixed rate penalty would be. If you are with a fixed rate, then now your penalty is calculated a little differently, and there's not a universal calculation. Every lender does it a little differently. Just know that when you have a fixed rate mortgage and you break it, it's basically much higher. It could be, this is just shooting at an example, but it could be a difference of 3,000 to 25,000. Like it could be that big a difference.
Yeah. That's I've seen some where like 16,000 and change. Yeah. It's quite significant, and certainly these are the things people don't think about. There's so much extra things on the side. I find a lot of people will they'll race to the bottom to get the cheapest price, but then they'll regret it later on when they realize there were details other than that should have been considered. But at the end of the day, who can blame a buyer when all they're thinking about is how can I afford a mortgage for this amount to get a house that's reasonable
Right.
for them. But thank you very much, Chloe. Really appreciate your time talking to us today about interest rates and mortgage insurance and all of those fun, complicated things. I'm certain that anyone can reach out to you for more clarity on any of these topics. But I do greatly appreciate your time today on Ask an Expert.
Thank you.
Have a great day.
Yes, see you later.